Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is American Water Works Company, ticker AWK. In the next 5 minutes, I will discuss both the valuation of this company and the quality of this company using QuickFS. Let's dive right on in. So the first thing up is this is a company in the water utility industry. So this is a utility company, and it provides water and wastewater services in the United States. So that's relevant. Sometimes water utilities are better businesses on stuff like islands than broader areas like the United States, but we'll see as we dive in what this looks like. So they serve both, it looks like residential customers and commercial customers, food and beverage, commercial property developers, various things like that. So they're focused almost exclusively on water, so that's helpful information. The next thing that we want to see here is the beta 0.38 is significant. That means it's relatively low volatility. The lower volatility there implies a relatively higher quality business, because lower volatility in the stock usually means lower volatility in the fundamentals, but that's not always true. Next thing I want to see here is return on invested capital. No, so what I don't like seeing here is these losses. So for it looks like 1, 2, 3, 4, 5 straight years from 2005 to 2009, they had losses. But since 2009, so for the last decade, 12 years, they've been profitable. And it looks like their return on invested capital has been increasing over time. So that's a good sign. So you see in 2010, it goes from 2.7, 3.1, 3.5, 3.5, 3.9, 4.2, 3.9, 3.3, 4, 4.1, 4.2, up to 7%. So the last year seems weird. I don't know if that's a real number here in 2021 at 7%, but I like the stability and I like that it's been increasing over time, because it means maybe there's some promise of higher returns in the future. Because when I see returns on invested capital of 3-4%, I don't get excited. That's very low. You basically need debt and leverage in order to justify that as a shareholder. So not a very good sign. But the stability itself is good. Now, if we look at valuation, PE of 21 is quite high. And really, when you're thinking in this return on invested capital, return on equity below 10%, you want to be saying book or less. And so at 3.7 times book value, that's a sign that you're overspending for this company. So I think the valuation is quite high. I wouldn't pay a price this high. But maybe that's because of the CAGR on growth. So the 4% revenue growth is key here. What you don't like to see is that assets are growing faster than revenue. However, curiously, you have EPS growing much faster than assets and revenue. So that implies some operating leverage here, and that is what it looks like with this growing return on invested capital over time. So maybe they're getting some scale benefits. It's not super easy to tell. But if we look here at gross margins, you can have growing gross margins as well. You started at 53%, 55, 55, 55, 54, 59. And so now you're up in the 57% range, although 2021 is a weird outlier. So overall, fairly stable, indicates a relatively strong quality business, but that's true for many utility companies. The downside is this return on invested capital. We can see if we just go from 2012 to 2020, it looks like earnings per share double over the course of a decade, which would imply an EPS closer to 6 or 7% growth over time, which is more what I'd expect. So I'm assuming there's some sort of outlier here with the 695, because in a utility company, that's a big jump higher than you'd expect. But I'd have to do more work than I can do in a 5-minute review in order to analyze that. One thing I like to see here is that starting in 2018, you pass 10% return on equity. So that's like the minimum I would consider is 10%. And so now that we're in the double digits, this company starts to become a little bit more interesting. But the past is quite bleak. So we need to know, is that going to continue in the future? So I immediately want to check here the shares outstanding. So it looks like shares outstanding have grown slightly over time, basically immaterial. They're relatively flat. You're talking about maybe a 1% increase over the course of a decade. That's not a big deal. So gross profit, profitable every year there. Operating profit every year there. That's a good sign. But again, not much growth here. So it's really flat overall. There's a big jump here that doesn't make a lot of sense. And it looks like, here it is. Other non-operating income is having a huge influence here. So really, these numbers that we saw on the first page don't add up. And so they're not real. That EPS growth isn't real. It's more accurate to use the 2020 number. And in that case, you're saying you basically have $3.91 per share is probably your earnings. call it $4, and maybe that's what it works out to. If we go back to the close, so $4, you're basically at a PE of over 30. This company is incredibly overvalued. For me, that's an instant pass on American Waterworks. It's just too expensive. I wouldn't pay 30 times earnings or more for a company like this. And I think that this income is probably not sustainable because it's coming from other income, and that's probably maybe an asset sale or something like that. Balance sheet. Let's see what our debt situation is. So you've doubled your debt from $5 billion to $10 billion over that period. It's not egregious if we compare that to the market cap. Yeah, so it's maybe a third of your balance sheet is debt. That's helpful because it gives you that return that you needed on equity. So no problem there. Let's see. So you're paying cash dividends. That's good. It looks like you're continuing to grow debt over time, and so you're not really paying down debt. But you kind of need that in order to justify buying a company like this. So I would really want to know, like, what is the sustainability of increasing your return on equity? But ultimately, this number is just a little too low. We've already seen that the 7% number isn't real. So unless you could get up to that 7% on a sustainable basis, this company's a pass. It doesn't make my watch list. And so I would pass American Waterworks Company. Don't forget to like this video, hit that subscribe button, and ring the bell in order to get notifications as I upload future videos. Thank you for listening. And until next time, stop paying fees, start building wealth.